Good afternoon, everyone. I'm Holly Caraccio. I'm the managing partner at Nexus Advisors, and our team here at Nexus wants to welcome all of our clients and family and friends today for our town hall series. Today's topic, as you know, is about essential information regarding the upcoming proposals that our administration is putting forth on taxes. And this is creating a lot of questions and stress with our clients. And so we want to be sure and bring to light what's being proposed. So Nexus, our mission is to implement meaningful and innovative solutions for individuals, families, and businesses. So most of you on this call are valued clients, and we really appreciate you being here today. I want to briefly make introductions, but before I do that, I wanted to let you know we are going to save the last 10 minutes or so for questions. If you've been shy and you didn't submit a question, or if you'd rather not say it out loud, you're welcome to email it to my email at Holly, HOLLY, at Nexus, NEXUS, DFW.com. So if you email those questions, then I'll bring them up for you. And so joining us is my business partner, Andrew Epps. And Andrew's been with the group for over 5 years. And he's been a financial advisor since 2011. And that was after migrating over from a teaching and coaching career. And our guest speaker today is with PIMCO, and his name is John Nersesian. Hopefully I said that okay. And he's the head of advisor education with PIMCO, and he has more than 35 years experience in investment and financial services. And he's got a previous background with Nuveen Investments as the senior director of wealth management services. And also he was the VP of the Merrill Lynch private client group. And he speaks frequently to media. So he's going to be talking to us and enlightening us on this very important topic. So I'm going to hand it over to Andrew so that he can kick us off.
Great. Thanks, Holly. Before we jump in and ask John questions, I just had a couple of announcements. First of all, we launched a revamp of our website a couple of days ago. And so we want to encourage you to go check that out. Our goal was to make that more interactive, to be more of a home base for client-centered resources and our planning websites. And so you go to nexusadvisorsllc.com to check out our new website design. Also want to make another announcement in the spirit of the tech updates that we're having. We have a new tool called Investor 360, and we're just rolling this out to our clients a little bit at a time. But as attendees of this webinar, or if you're listening afterward, please send us an email, either me, Sharon, Holly, and request access to Investor 360. It's a comprehensive tool to view your accounts, statements. You can link outside accounts. And so it's just a really great tool that integrates a lot of things that we're looking for in one spot. So now I'll jump in and we'll let John tell us a little bit about himself. And then we'll get in to start asking him some questions. Actually, John, we'd love to share a little bit about PIMCO as well. So go ahead.
I wish I knew something about PIMCO. I'm going to let maybe Kimball cover that a little bit later on.
Fair enough. Okay, yeah.
Yeah, I'd be glad to share with you my background and areas of limited expertise. So my name is John Nersesian. I do work for PIMCO. I'm the head of advisor education. As was mentioned in the introduction, I spent 15 years at Nuveen. I spent 20 years at Merrill Lynch Private Bank, where I worked with wealthy families and ran a series of advisor education training programs. I'm also an adjunct faculty member at Yale University and the University of Chicago. And so I spent a lot of my time and energy thinking about the same kinds of things that you do. How do we learn more about financial planning and investment management? How do we make better decisions? How do we make sure that the wealth that we've accumulated is properly managed? And maybe most importantly, how is it used effectively in bringing happiness to ourselves and our clients? And I know the folks at Nexus, that's a cornerstone of who they are and what they do and some of the benefits that you derive by working with them. I have been talking a lot about taxes recently, and I do want to offer some cautionary tales, Andrew and Holly. I know the temptation is to read the headlines, and we see them every day, right? Biden tax proposals, higher taxes are coming, and the immediate knee-jerk reaction is to do something, right? I'm going to go ahead and realize my capital gains now while the rates are lower. I'm going to go ahead and gift property to charities or as part of my estate planning process because I believe that the capital gain rates are going up. I'm going to take irrevocable action, which I believe to be in my best interests, but I would caution everybody to slow down a little bit. I love the fact that we're learning about taxes and maybe discussing what may or may not eventually evolve. But I would suggest that it's probably premature in many instances to take irrevocable action. Meet with your advisors, understand the complexity of the tax proposals, understand how they fit or affect you on an individual level. Some components of the proposal will affect others more so than others. And then let's have an intelligent conversation as we make our way through the end of the year and as legislation becomes somewhat more clear. I hope that was an effective introduction.
Oh, no, I appreciate it, John. Thank you very much. I guess we can start off by talking a little bit about the bill itself, and then we can transition into, okay, what are maybe the likelihoods of some of this stuff becoming a reality? And then we can transition to, okay, what should clients do to prepare? So I guess, first of all, just tell us a little bit, what do you feel the objective of the bill is? I know sometimes it's hard to separate the politics from the actual, like, all right, what is just the nuts and bolts? So would you mind just telling us kind of what the objective of this whole thing is?
I'm going to give you the obvious answer, and then I'm going to give you one that may be somewhat thought-provoking or controversial. How does that sound? Let's start first with the obvious. So on May 28th, President Biden published his Green Book. That's the budgetary process. And in there was, of course, reference to revenue generation to cover the $4.1 trillion of infrastructure spending that they've put forth. That's part of course, the American Jobs Act and the American Family Plan. And both of those collectively will produce about $4 billion in spending. Oh, I'm sorry, $4 trillion in spending. There's still some negotiation, but the Green Book attempted to demonstrate where the appropriate revenue would be generated. There are a number of factors as to why this is coming forward, right? Number one is the obvious. We don't want to necessarily increase our debt while we pay for these important social programs. There's maybe a secondary reason behind the potential legislation, and that is, to put it directly, wealth redistribution, a more progressive tax code, one that asks upper income folks to pay more of their fair share in order to provide the funding necessary to provide basic social safety nets for those who are maybe a little bit less fortunate. So the obvious answer, got to come up with the money to pay for the infrastructure plan. The less obvious answer is to restructure the tax code to shift more of the burden at the upper end and provide relief at the lower end.
Okay, I appreciate that. So can you share a few of maybe the key provisions that are in here that our clients might find valuable? And I think probably, and then I guess I have a follow-up to that, which would be what maybe is new to this, as opposed to just, we kind of play volleyball with the tax code where one administration's in, they change it and they change it back. We kind of see a little bit of that going on here, but what might be something that's a little more revolutionary, a little more new to the proposal that we should know about?
Great question. Let's start first with some of the basics. Let's make sure that all of our friends are familiar with some of the basic components of the Biden tax proposal. And then maybe we'll dive into some of the things that are new or maybe a little bit unique, if you will. Here are some of the basics. And they're covered, by the way, in the paper that I had co-authored. I'm glad to pull that up, or I suspect that you might be sharing it with your friends a little bit later today. Let's start first with the most obvious, ordinary income rates. And so we know that for couples who file a joint tax return, we know that previously the maximum ordinary income rate was 39.6%. That was lowered to 37% under the Tax Cuts and Job Act of the prior administration. What the Biden administration is proposing is an increase back from 37 back to 39.6. But what's maybe less obvious to folks, but equally important, it's not just a higher rate, It's where that higher rate begins. So previously, the 39.6, or I should say currently, the 39.6% rate begins only when your family's income exceeds $632,000. The proposal is to raise that marginal rate to 39.6, and that will begin now at income levels of 509. 509. And so we'll see a significant implication for many clients in that income level. Higher rates from 37 to 39.6, and that higher rate applied against or starting at a lower income level. Let's talk a little bit about a couple of other key components. Capital gains, right? It's something that your firm does a great job of producing positive results for your clients and helping them allocate their portfolios correctly. It's something that your clients are very directly involved with in terms of the investment management function. Capital gain rates today are about as low as they've ever been in history. They're 20%. You've got a marginal rate or an incremental 3.8%. That was part of the ACA taxes. That's applied against or for families above $250,000 in adjusted gross income. This is maybe the most controversial of all the different components of the Biden proposal. It's to take capital gain rates up to ordinary income rates, which may wind up being 39.6% for clients who report total income above $1 million. Now, that $1 million calculation is important to understand. So let's say hypothetically, Andrew, I work for a living and I make $700,000 this year. And let's assume that I realize some capital gains through the great advice that your firm delivers to me. And I wind up generating a realized capital gain of $500,000. In aggregate, that puts me over $1 million between my earned income and my investment income. That $200,000 that is over that limit would be subject to that 39.6% rate. And that is rather significant when compared to today's levels of 20%. A couple of other things that are part of the proposal and may or may not see the light of day. We think the ordinary rate increase is going to happen. We believe that capital gain rates will go up, maybe not to the way that I just described them, but maybe to a more moderate 28%. Let's talk about something that's really controversial. Let's talk about the elimination of step up in basis at the time of death. In the Green Book, there was a rather controversial component that said, if I make a transfer of my assets, either during life, an in-life gift, or at the time of my demise, number one, unlike prior events where that transfer took place without a realized event, that'll result in a recognition of a capital gain at the time of the transfer, not when the new beneficiary winds up selling the asset. And it would not receive a step up in basis. We're probably familiar with step up, right? It says that when I die and I leave my family business or my stock and bond portfolio to my kids, that they inherit those assets and that their cost basis, if and when they sell the property, is the value at which they inherited it. This would completely undo that, result in both an immediate tax recognition and one, of course, at a more significant rate without that step up in basis. Now, there are some exemptions that you should know about, the first of which is spousal transfers. So if I give my wife an asset of value, there will be no realization of the taxes of the gain at the time of that transfer between spouses. Number two is real estate. And so if I go ahead and pass on real estate to another generation, that would not become that realized taxable event. And the third is a $1 million exemption. So it's property above the $1 million threshold that would wind up producing that realized event and the loss of step up in basis, which means a much larger tax bill for those who inherit or receive property.
So that's interesting. That's almost a way of creating an estate tax on a lot lower threshold. I mean, in effect, that's kind of what it's doing. Am I looking at that right?
Absolutely. I love your observation, because in earlier iterations of the Biden proposal, they very directly addressed the estate issue. So all of our friends on the line know that we're in a very favorable estate tax environment today. Just to show you how old I am. And I know my suntan doesn't suggest I'm very old. I'm older than I probably look. I started my career in 1981, and some of you may be able to guess the number. The estate tax exemption when I started my career was $650,000 with a marginal rate of 50%. for all assets above it. Today, we're sitting here with an exemption amount, and I still can't believe that we have this opportunity. It's 11.7 million per individual. That's $23 million per family. But the challenge is that that number is set to revert back to 5 million when the Tax Cut and Jobs Act expires at the end of 2025. And it is very conceivable that the Biden administration in their eventual or final legislation takes that number down. Separate from the estate tax, you're 100% right. That loss of step up in basis is another way to essentially tax assets that are transferred from one generation to the next. I guess it's to prevent the dynastic creation of wealth among legacy families. And it's not to harm them, I don't suspect. It's to ensure that revenues are produced from these very wealthy families to support some of the programs we've been discussing.
Yeah. And on that step up in basis, would there be any effect on maybe a family-owned business with that change?
Yeah, that's one of the unknowns, is how family businesses might be treated. And I know I've had conversations with many families who are actually looking to, and this would certainly not be the only reason to engage in this strategy. They're contemplating the sale this year. Hey, I'm going to go ahead and pull the trigger on this thing when I'm looking at 20%. And while I know what those estate tax rates look like today and the exemption amounts, as opposed to continuing to operate this business and then having these variables affect me in a negative way a little bit later on down the road.
Yeah, one of my concerns was if you have a small business owner that builds up their net worth primarily in their company for many years, and unlike an executive that accumulates all their life savings in a 401k and mutual funds and things like that, and they're not having to all of a sudden recognize all their gains at once when they liquidate for retirement, like a business owner does. And so somebody that might have a $2 million business all of a sudden could be giving away a huge chunk of money if they implement some of these capital gains.
Holly, it's a great point. So stop and think about this. If I transfer assets, let's call them financial assets, from one generation to the next, I don't like paying the taxes or having my family pay the taxes, but I can easily call my financial advisors and come up with the liquidity needed by liquidating certain assets, maybe borrowing against the portfolio, or some other ways to pay the taxes if they're due. What do I do with the closely held business? You want me to sell half of the business as a way of coming up with the necessary funding? So I think there's more to come on the closely held business front. Another related item, and I want to mention it because I see a lot of people who don't necessarily take advantage of it, or they're unaware of it. Separate from the C Corp, right? We're familiar with big companies that are C Corp. They're incorporated, and we know that those rates went from 35 down to 21. That rate's probably going back up to 28%. At least that's what Biden's proposing. Our Washington folks think it's probably going to wind up around 26 with a minimum GLTI of 15%. But let's talk about maybe something more relevant for all of your clients. The closely held business owner, the sole proprietor, the LLC. They are entitled to a very unique provision in the current code called the 199A deduction, QBI. It's the idea that as a consultant, as a closely held business owner, pastor entity, I calculate my taxes, my net taxes due, or my net income on Schedule S. That flows over to my personal tax return, and in the process, in order to provide similar relief that the C Corp reduction provided, I get a 20% deduction. Now, there are some exemptions. There are some exceptions to that rule, specialized service businesses, but it's a unique planning opportunity for those who run a closely held business. And that's why it's so darn important for these individuals to get appropriate financial counsel. The amount of income that I realize through a Roth conversion, through a taxable bond portfolio, through the realization of a capital gain, all of these, and the associated deductions that I might take by making a significant charitable gift or other significant retirement account contribution, all of these factors either raise or lower my income, which then provide me with the benefit that I've described in this pass-through 199A deduction. Hope it wasn't too granular for the conversation we're having.
No, I think that's great. No, that's exactly what we need to know. Is there anything else in there that you think would affect the businesses?
On closely held businesses, I guess for many business owners, right, it's the capital gain that I'll realize. It's whether or not I get the step up in basis. I think the big one for so many business owners is the estate tax issue. The fact that we've got a rather large number today and what a lot of families are looking at. And this is true, by the way, not just for business owners. This would affect retirees or corporate executives who happen to have amassed a significant level of wealth. There are a couple of questions I want to ask our friends that may be somewhat thought-provoking, and they're intentionally so. The first question is, okay, look, we know we've got 11.7 today, $23 million for a family. And we highly suspect that that's going to be affected one way or the other, either the loss and step up or maybe a reduction in the estate tax exemption. And a lot of people, for whatever reason, they're just uncomfortable addressing estate planning, right? I don't know if it's, discussing our eventual demise. That's not necessarily a pleasant subject, or the significant taxes that our heirs will pay. And that's certainly not something that we wish for. But for whatever reason, people are reluctant to engage in or embrace an estate planning discussion or effort. So I've got 3 questions to ask. Number 1 is, when do you think you're going to pass away? And that's obviously an unknown. The second question I'd like to ask is, how much do you think you'll have at the time of your death? And then, of course, the third question is, what do you think the estate tax exemption will be in the year of your death or demise? And obviously, I'm being somewhat facetious. It's impossible for us to answer any of those 3 questions. And that's what requires us to maybe take a closer look at it today. A great strategy is gifting. But one of the downsides of gifting is we're making it a revocable gift as a way of removing these assets from our taxable estate. I might want to take a look at other advanced planning strategies. I can give to charity and those assets are removed from my taxable estate. I can use discounting mechanisms like grantor or retained annuity trusts or family limited partnerships with a closely held business owner as a way of gifting assets of reduced value. A great strategy that I think is very appropriate for very wealthy families to lock in that value today while still preserving some flexibility is known as the Spousal Lifetime Access Trust, where each spouse holds assets in their own trust, locking in that value today, as opposed to guessing what the number will be in the future. And then they have access to the income and under certain circumstances, access to the principal. So a little bit advanced, may not be suitable for each and every client, but my bottom line recommendation is don't ignore it and hope for the best. We have a unique opportunity today. I'm almost 100% certain that taxes are going up. Ordinary, capital gain, business, and estate. We need to have conversations and engage in some planning to prevent that from happening.
Okay. Thanks, John. I'd like to transition, talk a little bit about deductions that our clients have now.
What deductions, Andrew?
Yeah.
Which ones are still left?
Well, I think one of the more fascinating things about the last round of tax cuts was the increase in the standard deduction, which maybe you can explain a little bit, and maybe what they're going to do with that. But then on the flip side, they limited the amount of state and local taxes that you could deduct. So we have clients that might have real estate where their interest on their mortgage and their property taxes go above the 10,000. And so they might be affected if this thing is lifted. And so just talk a little bit about the SALT deductions and the standard deduction, would you?
Listen, I'm glad to discuss it, but I'm going to really upset my friend Kimball, who's on the line with us today. I know that most of you are down in Texas where you have no state income tax. My friend Kimball is a California resident. And so you've definitely poured salt on an open wound. But for Kimball's benefit and everybody else's, let's talk a little bit about deductions because the landscape has changed. So I remember growing up, either as an advisor or now actually I'm a client that you would likely serve. We took advantage of our deductions under Schedule A. And you remember what those were, right? Medical expenses, mortgage interest, state income taxes. I used to be a resident of the lovely state of Illinois, but I'm now a resident of the state of Florida. I have a home down in Naples. Charitable giving is deductible, and even something known as miscellaneous itemized deductions, where I would embed additional fees, including advisory fees and personal interest expense, et cetera. All of those amounted for an itemized deduction tally. And I take that number and I would compare it against a much lower standard deduction. Clients or taxpayers had the choice. If the standard number, which was $12,000, if that provided a greater benefit, I took it. If the totality of all those itemized deductions produced a greater tax benefit, I took that. 65% of taxpayers prior to tax reform elected the standard deduction. To your point, the math has changed. Two things have happened. The standard deduction is much higher today. It's gone from $12,000 to $25,000, and the available deductions that I can utilize are significantly limited, including, as you referenced, a very capped or a very modest $10,000 for state and local taxes. This shift in the regime that I've just described has resulted in a pretty significant change in people's use of the standard deduction. 90% of taxpayers today use the standard deduction of $25,000 because that number is greater than the limited number of itemized deductions that are available under Schedule A. Let me review them again, just to make sure that our friends are aware of which ones are still around. Number one, medical expenses. But what's the but, Andrew? I can use medical expenses on Schedule A. They gotta.
Is it 7.5? But it has to be above 7.5% of income. Yeah. Okay.
You got it. I can use medical expenses, but they've got to exceed 7.5% of my AGI. And so I don't know, maybe people plan their medical expenses. Maybe I don't do my hip replacement and my, I don't know. Give me another example of a surgery I need. Something else. I pass on those medical expenses and I try to bunch them together. That's very unlikely. The second deduction available is state and local taxes, but it's capped at 10. The third available deduction is mortgage interest. But mortgage interest is only deductible to me, A, if once again those gross numbers exceed the 25 standard, and B, if I happen to have a mortgage. And then finally, the last deductible item on Schedule A that's still available to most of our clients is charitable giving. And I know that you and Holly and the rest of the team have had conversations with your clients about charitable giving, not about giving away more of their money. That's not the conversation. It's about taking the giving that they're already doing. Your clients are generous. It's about making sure that the giving that they're doing is done most effectively to save them money in the process.
Yeah. So you mean something like, it has different names, but like bunching your deductions, where you would, instead of making my standard contribution to charity every year, I might skip a year and double up to be able to get above the standard deduction, or maybe even do 3 years or whatever the math is. You mean something like that, right?
Yeah. So let's use a hypothetical example. I give $10,000 a year to the Armenian church in Evanston, Illinois. My wife likes to write lots of checks to the church. And it's great, by the way, because it's important to us and, we love to share. But so let's say hypothetically, I'm writing that check for $10,000 every year. I don't know at the time that I'm actually writing the check, or when I'm going to that charity fundraiser this weekend, the Black Tie Affair, I don't know when I'm writing the check whether or not I'm receiving an associated tax benefit, because I don't really know at that point in time whether or not the total number of itemized deductions is going to allow me to use that, or whether or not I'm going to be claiming the standard deduction in that year. And so there's two recommendations that we have. Number one, I love your point about bunching deductions. So maybe I give 20 this year and 0 next, or maybe I front load my deductions. If I'm giving $10,000 a year to my church, hypothetically, and I'm going to do that for the next 20 years, that's $200,000. Maybe I put in $200,000 or some discounted number into a donor advised fund today to receive that significant upfront deduction that is of maximum tax benefit to me. By the way, the money grows tax-free inside the account. By the way, I don't fund it with cash. What do I put in instead? I put in that highly appreciated United Healthcare stock, or whatever assets that I'm thinking of liquidating or rebalancing within my portfolio. And so I derive an additional tax benefit. My wife and I established a donor advised fund 12 years ago, when the firm I was working for at the time was sold. And so there was a significant, financial event. And so we created a donor advised fund, and we did exactly as, what we're discussing today. We bunched our deductions. We made the upfront gift. We put in appreciated property. We avoided that 3.8% net investment income tax. The dollars were removed from our taxable estate. The money grows tax-free along the way. 85 cents of every dollar we give to charity today, guess whose money it is? It's not mine. It's the government's. It's the money that we saved in taxes by being what I call strategic or intentional regarding our philanthropy as opposed to reactive.
Good, thank you. All right, now, let's transition a little bit and let's become political prognosticators, if you will. And so tell me what you feel the likelihood of any of this or some of it really becoming law. I mean, we look at a very divided Congress with very, very close election. Typically, it's kind of hard to get things done in that kind of environment. So, I mean, I guess give us your thoughts on this becoming a reality.
Yeah, and so I'm not making a political statement. Please don't interpret my comments as such. I'm simply providing you what we know or what we hear today. And so that's really my intent, is to inform, not to take a position necessarily. And so Biden came out under his tax proposals, and his claim was, his line in the sand is, I'm not going to increase taxes for those people making less than $400,000. The Republicans are coming at this in a slightly different way. They're saying, wait a minute, we're paying for infrastructure, whatever that final number is. And instead of taxing folks who create jobs and who have been successful, why don't we instead institute a usage fee on gasoline, on toll roads, on highways, on other services that are utilized by certain individuals? But the Biden administration feels that that would indirectly wind up increasing the tax burden for those below the $400,000 level. We've got a divided Congress. You could see some sort of compromise potentially with the narrowly controlled Democratic Congress that we're facing today. You may see reconciliation as part of the budget process. That could be an eventuality for some components. Here are the things that we think are likely and unlikely. I'll give them to you if you're kind of keeping score. Ordinary income, they're going up. You can take it to the bank. Now, you'll probably have me back next year after they decided not to raise ordinary income rates and say, John, you promised me they were going up and they didn't. And that'll be maybe one of the many times I'm often wrong with my predictions. But it's very likely that we'll see. I think it seems that both sides are pretty much in agreement of raising ordinary rates. The question is, at what level? Does it start at 509? Does it start at the 600 and change level that we're at today? Does it potentially start at $1 million and above? Let's talk about capital gains. They're going up. They're going up. And I get it. Capital gains, the lower capital gain rate, and I teach strategies on how to convert ordinary income to capital gains for executives, how you use things like the 83B election or the ISO exercise or 402E4 of the Internal Revenue Code as a way of buying company stock inside your K plan to distribute it. I get it that there's this significant disparity that works to our advantage, but there are some who might feel that that significantly lower capital gain rate provides a skewed advantage to the limited number of taxpayers who are fortunate enough to own capital property, right? If you look at the average American, and I know that doesn't represent your client base, the average American doesn't own stocks, or if they do, they own them inside their 401k. They're not building a sizable investment portfolio with Nexus. And so that's kind of the debate that's taking place. That's not my view. I'm not taking a side. That's kind of the debate that's taking place. How do you eventually wind up reconciling that? So we do think that cap rate gains are going up. We think you wind up at a Clinton era level of maybe 28%. I think step up in basis, or the attempt to eliminate it, I think that would be very, very difficult. I think it doesn't generate enough revenue, and maybe most importantly, would be very difficult to track and to administer. And so I think what we eventually wind up with, and this is just a guess, is not an incremental tax on wealth transfer by realizing the gain at the time of the gift and winding up with this loss of basis. I think what you wind up with is maybe a reduction in the estate tax number. Remember, it wasn't that long ago that the number was 3.5 million. Today we're at 11.7. So I could easily see that being a landing point where compromise eventually winds up. Corporate taxes are going up, not to an extreme degree. We don't want to make the US uncompetitive by taking that number back to 35, but it probably goes up from 21. And I love the GLTI because you hear the popular headlines and criticisms that companies like Amazon aren't paying anything in taxes. And so we've got this minimum tax, just like the AMT used to affect individuals. We've got this minimum corporate tax that makes sure that there's some equality in the system. How's that sound as a review?
No, that's great. I appreciate you going into that. So now what I want to do is open it up to any questions from the floor to see if any of our participants would like to ask you a question. Guys, you can go down to the raise hand button there at the bottom of your Zoom screen and just let us know that you'd like to be called on, and we'll bring you into the conversation here.
I did check email and I didn't receive anything. So
our speaker is so good.
I know you've answered everybody's question. Everybody's
that our
certain.
friends can ask.
Yeah.
at least one brave soul out there that wants to ask a question.
Well, is there anything on your minds that you've been hearing from clients that you'd like me to address, Holly or Andrew? I know we've covered a lot already. Is there anything in particular that you've heard from clients or that needs some additional explanation?
I would just ask, you encouraged everyone to not have any knee-jerk reactions this year out of fear. Are there any smart things that people could be doing right now in anticipation of what might happen?
Yeah, it's a great question. So traditionally, and there are always exceptions, but traditionally, whenever this country has debated tax reform, it's been a legislative process that's involved compromise, final legislation that becomes effective some date into the future. What makes some of these components so controversial and maybe so upsetting to so many of our clients is the fact that a component of the proposal would be effective as of April 28th. That's that higher capital gain rate that I referred to. So everything else that we've been discussing would become effective on 1/1/22, I guess, right? January 1 of next year. But the Biden administration, in order to prevent individuals from managing their way around this capital gain liability, came out with the claim that the higher capital gain rate would be effective as of the date of the announcement back in May for any property that was sold up till now or any property that we might sell between now and the end of the year. The remaining components, we'll have time. We'll have time. Don't ignore it. Think about it. Understand it. Have conversations with your advisors as to what the implications are, because a higher capital gain rate will affect Kimball differently than it'll affect me. A lower estate tax exemption will affect Sharon differently than it will Holly. And so make sure that you don't simply react to the headlines, but understand the implications of what is likely to happen and how it affects you at a personal level.
Good. No, that's good. All right. Oh, we got some questions coming in here. So let's see. Let's see.
So Thomas, if you will unmute, you can ask your question.
Can you hear me?
Yes.
I would like to know what steps that the industry is taking to fight these changes, which I think are just ridiculous. And I think they're going to affect the average person a lot more than they realize. The average person doesn't really have the wherewithal to engage in sophisticated tax planning. The other thing is that the industry clients have been relying for years on this tax planning. Now all of a sudden, you've got a brand new ballgame. And my concern is that industry professionals are looking at this as a marvelous revenue system rather than their first royalty being to their clients?
Great question, Thomas. John, go ahead.
Yeah, I'll take a stab at it, and I would love to hear your thoughts too, Holly and Andrew as well. Let's talk about the tax code, because that is the basis of your question, right? This complex, constantly changing tax code that we're all supposed to deal with or abide by. And I'm really with you, Thomas. So you got me there. I'd have a cup of coffee with you someday, and we'd probably be on the same side of the table there. I believe that the tax code exists for two reasons, two obvious reasons. Number one, of course, is to generate the revenue that we need to put police on the street and build airports and bridges and roads and, you know, and provide national defense and some social programming. I get it. It's to produce revenue, and that's great. But there's a second reason that the tax code exists. And you know what that is? It's to motivate individual behaviors. So I provide a tax deduction for an IRA contribution. Why? To motivate people to save for retirement. That's a good thing. I provide a tax deduction for mortgage interest. Why? To encourage home ownership and to make it a little bit easier for working families.
Charitable deductions.
Charitable deduction, great example. Thank you. Perfect illustration, Holly, on why the charitable deduction is still in place. The problem is when the tax code becomes so complex with all of these different parameters, we eventually lose sight of its ability to affect behavior. I don't understand it. And so it's lost its ability to motivate me to do things that are theoretically intended for everybody's good. When you talk, go ahead, Sharon. Yeah, please.
I was just going to say, Thomas brought up a good question, which is, what is our industry, you know, the financial services industry, the legal industry, you know, what are these different industries doing to try to lobby to help consumers and prevent some of these tax increases? What are you seeing?
My audio cut out there for a second. Could you give me the last part of that again, please?
So what are you seeing from our industry as far as lobbying against some of these changes?
Yeah, I don't know what the financial services industry is doing specifically. Our colleague, Libby Cantrell, is in Washington. She's got her finger on the pulse of what's going on. I do know that the real estate industry, of course, has a very significant lobbying position. And they'll definitely take a look at these different components and let their voice be known. And I know that the financial services industry, broadly speaking, isn't in favor of, and when I ran or chaired the Investments in Wealth Institute, I was down in DC every 6 months or so, talking about the industry at large and what we wanted our politicians, our legislators to put forth in terms of positive change that would have a positive impact on individuals who are working hard and saving for retirement. I do know that many of our legislators are trying to put forth bills or components of the code that have a positive impact on our lives. I'm not sure they're successful at it, but I believe that that's probably their intent. Retirement savings, a perfect example of that. We have a retirement crisis here in the US. I mean, your clients are so fortunate to have access to your guidance to tell them how much they should save and how they should invest and when they can afford to retire and how they should think about taking distributions once they reach that age. These are complicated choices for many people. So anything that we can do to provide additional safety or security to the retirement system here in the US, it's a great thing.
Awesome.
Yep.
Denny, you had your hand raised. I don't know if you wanted to ask a question. If you do, you can unmute yourself.
Can you hear me now?
Yes.
Do you anticipate anything happening with the 1031 exchange?
Yeah, it was part of the code or part of the proposal. Good question, Denny. It was part of the proposal earlier on, but was not specifically referenced in Green Book. Now, I don't know why that is. I don't know if it's if it's because the lobbyists got to the Biden administration or they found other ways to produce revenue. But as we know, 1031 exchanges provide a unique tax advantage for those who own real estate when they buy like-kind property. There's a certain period of time that we have to reinvest proceeds where we get to roll that original cost basis into the new property, essentially deferring the capital gain and avoiding a forced liquidation where we'd have to sell assets or reinvest a lesser amount because of the taxes that are due upon the realization of the first event. I know that there were some exceptions to the 1031 that were discussed, but I think we've got to see more to come on 1031 and whether or not it survives or whether or not it's limited in some form or fashion. I've read a number of pieces from the Tax Foundation that have addressed the 1031 exchange, and what they are projecting is some limitation as to the extent that the 1031 could be used.
Great, thank you, John. I think we have time for one more question. If anybody wants to ask one more. Anybody want to raise their hand? Okay, going. So thank you, Andrew. Thank you, John. Y'all did an excellent job addressing this topic. We do have a few ideas handy for our clients. And as we are doing reviews with you, we will certainly address your individual situation with you. And we will be recording this and sending it out to those who were not able to join us, as well as y'all. So if you want to share it with a friend or family member. So in PIMCO, Kimball, we appreciate you so much. We appreciate having y'all as a financial partner with us. And y'all are one of the important money managers that we utilize in our portfolios. So we thank you for being here for us and our clients.
Thanks, Holly. And yeah, appreciate it. And also thanks to Jackson National, Eric Holmes and George Washington. Those guys are great. They're the ones that put us in touch, and we appreciate them. Without them, we wouldn't be having this call. So it was great that they were able to connect us. So I just want to acknowledge them and thank you. Thank you both, Holly and Andrew, and obviously John, who I work with quite extensively, and I always enjoy his knowledge. So thank you all.
Thank you so much. Everyone have a wonderful rest of your day.
Our pleasure. Go
Great.
Frog.
Take care, guys.